Welcome to this explainer. Today we're diving into a truly fascinating macroeconomic phenomenon that's unfolding right in front of us as of mid-July 2026. The British pound is on an absolute tear. It is experiencing a massive, massive surge in the global foreign exchange markets. But, currencies don't just skyrocket in a vacuum, right? What we're witnessing right now is the result of a very specific, incredibly powerful alignment of global and domestic forces. It is quite literally a perfect storm for the pound.
Okay, let's jump right into this. Just take a look at this number, 1.3500. The GBP to USD exchange rate just smashed right through this impressive milestone. Now, if you follow the Forex markets at all, you know this is a serious breakout. But what's actually fueling this intense upward momentum? Is it just a weak US dollar, or is there a much bigger story brewing inside the UK?
To figure that out, here is our roadmap for today. We're going to unpack the three distinct drivers creating this perfect storm: the breakout, the interest rate magnet, and the new political landscape. Then we'll look at the specific strategy international traders are using right now before finally asking how long this temporary king can actually keep its crown. Let's get to it. All right, part one, the pound shines in its broad-based dominance.
Notice the undeniable sea of green here. This data shows the pound's performance against a wide basket of global currencies, including the G10. So this isn't just an isolated victory over 1 or 2 weak currencies, it's a broad, sweeping dominance. The pound is flexing its muscles almost everywhere you look. And honestly, for anyone engaged in global trade, traveling abroad, or managing an international portfolio, this sweeping strength fundamentally changes your purchasing power. To understand how we got here, we've got to look at the first major catalyst.
Moving on to part two, the breakout, as GBP/USD surges.
So over the last 2 days, we've seen U.S. inflation data, both the consumer price index and the producer price index, drop sharply. Because U.S. inflation is finally cooling off, the U.S. dollar has weakened broadly across the board. And that naturally narrows the yield differential, the gap in interest rates between the U.S. and the U.K. With the dollar losing its defensive strength, a massive hurdle was just totally removed for the pound. It essentially created absolutely ideal conditions for buyers to step in and push the GBP-USD pair higher. But a weak dollar is only half the story here. Which brings us to part three, the interest rate magnet and the Bank of England's stance. The absolutely crucial point here is this stubbornly high number, 2.8%. That's the UK's current consumer price index rate. While the US is seeing its inflation cool down, the UK is still fighting a really fierce battle. That 2.8% remains well above the Bank of England's 2% target. And why is that? Well, because inflation within the UK service sector is running incredibly hot, and wage growth for British workers is just relentless right now. The domestic economy hasn't cooled down yet, meaning everyday costs for consumers are still really elevated. Because of that stubborn domestic inflation, the Bank of England has to act tough. Get this, according to a recent Natix's IM survey, over half of analysts expect the Bank of England to actually raise rates again in the second half of 2026 just to bring inflation to heel. Think of high domestic interest rates like a giant magnet. In the world of global finance, capital is constantly looking for the best return. Keeping the local interest rate at these peak levels acts as a massive magnet, pulling in international capital and causing the value of the pound to absolutely surge. Now for part four, the new political landscape and a truly historic transition. The UK is currently undergoing a major, historic transition of power. Andy Burnham is set to be officially inaugurated as Prime Minister on July 20th. Now, as we know, whenever there's a major political shift, the bond market reacts. We're seeing the yield on 10-year UK government bonds, which are known as gilts, surpass 5.00%. While those high yields technically make the pound stronger by attracting investors seeking returns, it's kind of a double-edged sword. That 5% mark also signals some serious underlying anxiety. Investors are demanding high returns right now because they're nervously watching to see what the new government's fiscal, tax, and spending policies will actually look like in practice. All right, part five, the carry trade strategy and the overarching market mechanics. First up, we need to really understand the concept of broad-based GBP strength. This means the pound isn't just rising because the dollar is falling. Not at all. It's asserting a dominant upward trend against a whole host of base currencies: the Japanese yen, the Australian dollar, the Canadian dollar, the Swiss franc. It's a widespread phenomenon driven by the overarching mechanics of global monetary policy. This side-by-side comparison perfectly captures the current state of the global economy. It's fractured into two very distinct camps. On the left side, you've got the easing camp. The European Central Bank, Canada, and Switzerland have already started cutting their rates. The US Fed is preparing to join them as their inflation cools. But then, look at the right side, the tightening camp. The Bank of England is sitting there entirely alone. They are lonely at the top, forced to maintain peak rates due to that sticky service and wage inflation we talked about earlier. This extreme divergence in global monetary policy is the exact engine driving the pound higher right now. And that divergence allows speculators to execute what's called a carry trade. Basically, it's a strategy where investors borrow money in currencies with very low interest rates, and they use that borrowed money to buy currencies with much higher interest rates. The goal? To simply pocket the difference between the two rates as pure profit. It's a classic Wall Street move. Let's break down exactly how this is happening right now in 3 simple steps. Step 1, speculators massively borrow low-yield currencies, like the yen, the Aussie dollar, or the Canadian dollar. Step 2, just like water naturally flows down to the lowest point, actually, scratch that. In global finance, it's the exact opposite. International capital flows to the highest yield. Right now, that's the UK. And step 3, they execute massive, coordinated purchases of the British pound. This enormous global demand fundamentally pushes the intrinsic value of the pound higher against virtually everything else on the board. Which leads us into part 6, the temporary king. Just how long will this last? Let's summarize the equation that has crowned the pound as the current absolute king of cross-currency pairs. The perfect storm equals a weakening US dollar, plus sky-high UK interest rates, plus uncooled domestic inflation, which is forcing the Bank of England's hand. This trio of massive macroeconomic factors has created an environment where the pound just simply dominates. But you know the saying, heavy is the head that wears the crown. This setup is incredibly fragile. The extreme monetary policy divergence we're witnessing right now, it won't last forever. The entire market is sitting on the edge of its seat, waiting for 2 key catalysts.
First, the upcoming UK August inflation report. If inflation suddenly cools, the Bank of England might not need to raise rates, and that giant interest rate magnet will lose its pull. Second, everyone is closely watching the new Prime Minister. Any surprise economic, tax, or spending policies could instantly alter the bond market's calculus and shift the pound's trajectory overnight.
Which leaves us with the $1,000,000, or rather the £1,000,000 question. How long will this surge actually last? The perfect storm is raging right now, but the winds of global finance can shift in an instant. Keep your eyes on that August data and the new administration's very first moves. The next few weeks will dictate whether the pound cements its reign or if this temporary king is forced to abdicate the throne. Thank you so much for joining me for this explainer. I hope this helps you navigate those charts a little more clearly.